Hey everyone, hope they're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, like I normally do, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in, take a look, see what is going on today. If you want to follow me, it's at _finance. And if you want to join our community, finding-value.com. I go through a lot of stuff. I answer your guys' questions on the weekends, the Q&A sessions. We have a community. We've got a Discord channel that we talk back and forth from. I share my opinions about individual companies. I show my setup for the commodity portfolio that we're in this commodity bull market, how I'm positioning for it, why I'm positioning in certain individual companies, and some mindset around everything. We do these Q&A sessions on the weekends. They're all posted on the website. And I thought we had a pretty good one last session there, talking about Elliott wave and some of the fractals, which is a repeating pattern that repeats over and over, and showing you guys where we're at in this cycle, and why I think it's going to be a very big cycle. So if you're interested in joining, if you guys like looking at individual companies, if you like learning about the macro big picture view, definitely sign up, give it a try. We've got a coupon code special. It's 50% off the first month only on the monthly membership, and a larger discount on the yearly if you'd like to stick around longer than a few months. All right, so let's start with Brian. It says, success is when the day of the week has no impact on your happiness. Actually, I would agree with that. In fact, I would say this. Um, Monday through Friday should be the highlight of your week, if you can turn it into that. I love when the markets are open. I like watching the markets move. I have been fascinated with the markets ever since basically I graduated college. I wasn't too much into the markets when I didn't have any money to invest, but after I started working at 22 years old, I got very interested in the markets and how I could grow my wealth. Um, Back then, I mean, thinking about my mindset, I just wanted to save money and compound it and grow it. That's all I wanted to do when I was 22 years old. So it started with me not liking my 9 to 5 job. So I would say to most people, I would say find something that you really like doing if you can. If you can. If you can't make any money doing what you like doing, then that might not be a viable alternative. But try to find something where you get excited Monday through Friday, where you want to do it. You want to go and show up and contribute to whatever you're contributing to. If you can find that, I think you've won. Then you can work on making more money at whatever you like doing. And the most thing, investing, you don't have control over. You have control over your job and the outcome and how well you do at it and improving your skills, your knowledge around it. So that should be the first thing that you should dump time and money and resources into, is improving yourself to increase your income, to save more money and pile it back either into yourself or into investments. If you want to join the website, I'm not trying to plug this here, but I can help you guys understand the macro and help you understand uh, what looks good and why it looks good from these longer term cycles. It's not day trading. It's not trying to get rich fast in terms of um, trying to do like swing trading. I don't think that swing trading will work for the majority of people. Um, the shorter the time frame, the faster people lose money. is really what it comes down to. So, and yes, I've done all of that. I haven't day traded, but I used to swing trade. I used to read charts and invest on shorter time frames, and obviously, it's helped me become a better investor for timing investments. But over time, I've moved towards the longer holding periods and really sizing up the big moves. all done on purpose to maximize returns. You have to learn the game and switch to the game that works, is what I'll say. So yes, try to do this. Success is when the day of the week has no impact on your happiness. Paper is poverty. It is only the ghost of money and not money itself. What does that mean? That quote from Thomas Jefferson. Well, paper used to be claims to gold. So you could hand in your paper dollar, which was a claim to gold, and get your gold from the bank. Now, paper is poverty because it is only the ghost of money, money being gold and silver, and not money itself, which is gold and silver. So we are trading, quote, claims of gold and silver, which they used to be claim checks, basically. And now it's just the ghost of it because it's not a claim on anything. What do you think is the logical next step in this chart? We've got gold versus cash going up, gold versus bonds going up, and then the next one will be gold versus stocks going up. Now, that is what we're looking at here. A lot, when I was earlier in my investing career, I didn't like piece these things together because I wasn't looking as deep into it. All of these things mean something. They're all tied to cycles. This back here is an upward cycle driven by bank lending, demographics coming through home buying years, increasing interest rates, a suppressed gold price obviously shot the gold price up against these other assets. This here is a different cycle. The cycle from 1980 was a declining interest rate environment. And you can see a pause from 2000-ish to 2011. This is called a double bottom, and we're at the bottom of the double bottom almost. We've broken out of a little bit of a downtrend line coming through here, or pretty close to it. We'll break through this and go up, and this will be a big double bottom that will eventually break, come with a line coming across here. That's a big bottoming pattern. And then we're going to outperform for a long period of time, most likely, gold versus these other financial asset classes, cash, bonds, and stocks. That is what I was missing when I was younger. I didn't see the big picture. I didn't see the cycles. Nobody taught me this. I had to go through it myself, look at history, look at charts, align these things. And then you start to see repeating patterns over and over and over. And you kind of have to dig into the psychology of humans and the herd creating these patterns. Now, we don't know why they're created, but that's not the point. We're not trying to figure out why they're being created. We just want these patterns to exist and to replicate over time so we can identify where we're at in cycles to identify how the herd is reacting to the market conditions. And that's what's important. And right now, what I think is occurring is that the market conditions are shifting underneath our feet. And they're shifting in a way that is creating a gigantic double bottom. We're also seeing interest rates go up. Inflation and interest rates are correlated. And inflation and interest rates being subjected to the herd that trades in a system creates behaviors that are different than a declining interest rate environment. And that's what's causing the money rotation, in my opinion. So we know what the causes are. We know what the driving factors are that creates a difference in psychology of the herd. So we can use those as leading indicators. Ed Finley says inflation-adjusted oil and gas exploration spending has hit its lowest point in the post-World War II era. Now, some people will look at this and they'll say, Andy, your spending's down. That's bad for oil and gas. And I'll say, it looks like a bottom to me. Bottoms are made when spending pulls back. Tops are made when spending increases. So here's your tops, here's your bottoms. Now, if we're below the bottom here, if we're at the lowest level, since 1950s on a inflation adjusted basis. That means you have the largest opportunity in the market today, at least based off of this one metric. You can look at other metrics. You can look at the gold to oil ratio. That is also at a 50 to 1. It's over 50 to 1 ratio, which is basically almost the cheapest time in history. It's the second cheapest outside of the 2020 crash that went negative. So add these things up. This isn't about one piece of information. Add it up. What is gold doing? Oh, gold broke out. Yeah, and gold's a leader. Add up the information. Add up all these charts and all this data and keep those charts in the back of your head as you look at information. What you're trying to do is you're trying to piece together a complicated puzzle. And then what you want to do is you want to come up with an idea where you've got potential investments in the entire world. And then you say, well, given my lifespan and given where we're at in cycles, what's the highest probability of success for certain sectors during my lifetime for good returns? You can't control the market conditions. You're born into certain market conditions. In certain market conditions, we had gigantic moves in interest rates from the 1940s all the way to 1980. That's a 40-year span. So if you were 20 or 30 years old in 1940, and then you lived all the way till your 70s in 1980, that's almost an entire lifespan that you had an increasing interest rate environment. Conversely, a lot of the baby boomers, or shortly thereafter, Gen X, they've lived in almost an entire world and life in a declining interest rate environment. And it takes time for these big market shifts to occur and to impact the herd's psychology. So it may take some time for these turning points, and it may last, 5, 10 years for a turning point where interest rates have to basically knock people on their head and say, hey, look, things are changing. Performance of the goats of investing. So if you look really close here, a lot of these guys, they weren't up at 30, 40, 50, 60%. There are people that received those returns, but a lot of them are around the 15-ish percent or lower. Warren Buffett, now he's massive. I mean, he's got so much money. It's basically, he puts it where he's going to get basically the market return because he is the market, so to speak. But some of these guys, Jim Rogers was up around 30% or so for almost over 10 years. Stanley Druckenmiller, a little bit over 20%. Now, here's my question. Would you sacrifice a little bit of consistency for ultimate return? I would. I would sacrifice a year or two to get the ultimate returns for the performance over, say, a 15 or 20-year period. That's me. And I don't like trading in and out. You also incur taxes. So some of these guys' strategies incur more taxes than others, and I'm pretty sure this is before tax returns. I'd like to see, Warren Buffett, he probably, if you were to take, depending on who these guys are and where they trade and whatnot, I'd like to see their after-tax returns because you could have a lower return a little bit, and if someone's doing more shorter-term trading within 1 year, so to speak, you're going to incur short-term tax liabilities there. So, yeah, I think I'd like to see after tax too and see what those look like. Coming down, we got Valla. He says your two greatest assets in life is health and time. Invest in your health; it will buy you more time. That's probably the smartest thing I've ever heard. I mean, if you think about it, that's really all that matters. You can spend money on your health, but you can't spend money on time. And money doesn't mean that you'll be guaranteed good health. You don't have to make a lot of money, and you can still have good health. Without health, nothing else matters if you don't have your health. So yeah, it makes sense. The S&P 500 is up 47% since Michael Burry said sell. And he said sell 131 2023. And, uh, I just looking at YouTube, looking at a lot of things. Uh, I created my channel in 2020 because I saw a commodity bull market coming. We were at the bottom of the ratio. The ratio started to turn in March and April. I created my channel in the summer of 2020, where I had invested in gold and silver in March and April, mainly April, with small little companies. It went up tremendously. I was, I didn't, it was kind of by happenstance. I got out of tech stocks in 2019, um, and I reinvested everything in April 2020 into. I also bought a lot of physical metals too, but uh, physical metals into a lot of gold and silver mining companies' equities. They went way up, and then I swapped it in September, October of 2020 into a lot of oil, gas, uranium. In fact, some people reached out on YouTube, um, luckily enough, and I spoke to them over the phone even about some of the uranium companies, learning about the uranium companies in that sector, and I'm thankful for that. I was not perfect. Well, I mean, it ended up being very well timed. But there's a lot of luck involved too. It wasn't all planned like that. So I'm not stating that everything I did was planned. It was a good chunk of luck too. I just knew that from 2008 when they did stimulus, we saw a big move in precious metals pretty quickly after that stimulus came in. I also knew from that time frame that commodities went up tremendously. I played well, it was back then. It was Tech Kaminko, which is a mining company. I was buying it at, I think, if I remember correctly, around $3 a share, which was really low in 2009. I think it was the beginning of 2009. If I can remember, I think it was like uh, March. It was the beginning of 2009, somewhere in there. I rode that all the way up to $30 and sold it. I didn't know as much as I do now, but I sold it around that 20 something $30 mark. Made a lot of money in a very short period of time. So I knew that stimulus turned that market around very quickly. And I didn't think we had a 2008 crash in 2020. So when I think about 2020, I was like, man, the economy is not bad. They just stopped it. And then they printed a bunch of money, handed out a bunch of checks. And I was like, oh my God, I think they're just recapitalizing the banks by giving money into the bank accounts. So I think they recapitalized the banks kind of hidden when they gave out all the stimulus checks to people to pay down debt too. So I think it helped that as well. And I was like, man, they're gonna moonshot oil. They're gonna moonshot gold and silver, and gold and silver. I was pretty sure that was gonna move first, just because of how it behaved in 2008 and nine. So I used my previous experience to gauge that. Dow to gold ratio, gold secular bull market. We're rolling over here. Looks like a shoulder head shoulder even on the Dow to gold ratio with a nice little neckline that we are breaking. So yeah, I think we're going to go into a commodity bull market, and that's when gold outperforms the Dow. I think this is going to be a big one, guys. It's going to be a very big one. Why do I think it's going to be big? Because interest rates are going to force money out of bonds, which it is, and it could impact stocks too. And if we start to see precious metals go up, like we did in the 40s all the way to 1980, we could see a big move. I am positioned from the bottom for that to occur, and I am positioned very long. And I am patient enough for this to play out. Now, the move may last the rest of my life. As weird as that sounds, it may not. We'll have to wait and see. And see what kind of patterns we get and how big those patterns are and look at the fractal sizing. And again, fractals are repeated patterns over time. And it's a little bit, associated with Elliott wave if you guys want to look into it and see what that is. Elliott wave theory, if you want to type it in. Brian Feroldi says selling a future mega winner early is the biggest investing mistake you can make. Yeah, that is correct. And a lot of people are going to mess this up if you're young. All I'm going to say is listen to people who've rode through this before. I made some mistakes myself my first commodity bull market. Now, I didn't enter at the beginning of the commodity bull market. I entered more towards the middle of it. So I started working in 2004. 2004 was smack dab in the middle of the commodity bull market, and I saw some crazy things occur. There was some natural gas companies that went up from bottom of late 90s, early 2000s, all the way up to their peak over, I think it was 100x on a few companies. Yeah, a few. We're talking 30 to 100 times returns. I also saw some ridiculous fertilizer company returns. I'm talking massive, not a 10x. We're talking multiples of 10x, 30, 40x. I think it went up 100x if I can remember. It's been a while. From bottom to top, and it went up vertically. It was like, holy smokes, this thing went. I didn't capitalize as well as I could have. I made a lot of mistakes that early investors make. What they do is they sell after they get like 1, 2, or 3x. And that's what I was doing. I was riding it up, getting like 100 or 200% return, and then selling it. And then I would see it continue to go up, and then I couldn't buy back in because if you sell it at, say, let's just make up a number, $20, you don't want to buy it back at $30 or 25. You don't want to buy it back. You're like, oh, I'll just wait for a pullback. And then the pullback never pulls back. It just keeps going. And then you feel like crap. You're like, God, what the heck am I? So I didn't know what I was doing back then. I didn't know what was overpriced. I didn't know what was underpriced. I didn't know the cycles. I was basically investing blind. And that's where my problems were. My problems were is that I didn't create the three pillars, didn't know the three pillars even existed. I was just a new investor and I didn't know what the hell I was doing. I didn't know, I didn't have an orientation. I didn't have a compass. I didn't know what was north and south and east and west. I didn't know anything. And I was trying to listen to people on YouTube, the Michael Maloney's back then, and some other people, Peter Schiff, the normal guys that have been around for a long time. That's 20 years ago if you think about it. And that's where I messed up. I was listening to quote experts, and I didn't look into it myself. So after I figured out that the experts were quote um, saying the same thing, but things weren't playing out, I knew there was something that they didn't see. So I looked at it myself in the 2010s. I was still working, so I didn't do it a whole bunch. I wasn't like looking at it every single day. And getting information back then, I think, was a little bit more difficult in the 2000s and 2010s than it is even today. And now it's even easier with artificial intelligence and whatnot, but you have to know what questions to ask. So I was investing blind, and I can't fault myself back then. I didn't know. I mean, I just didn't know, and I didn't know how to know. Um, and that's exactly what I'm trying to do on the website is to let you guys know what's important, what you need to know, what was my downfalls, what you need to look for, and how these patterns are playing out and stuff. So I didn't know technical analysis that well. All I knew was how to read charts, like some of the patterns and stuff like that. But uh, you need to know more than just patterns, in my opinion. Here's talking about patterns. Kevin says the picture is macro investment porn. We are pattern recognition focused biological supercomputers, and this chart triggers me in a profoundly powerful way. It does. It's a big cup and handle that's starting to break out. And guys, this thing is ridiculous. And I like what he says here. He says, silver's breaking out from a 45 formation and people are locking in profits on day one. This is why most people will never make life changing money. I think I talked about that yesterday. Um, that's one of the biggest mistakes people will make. The biggest mistakes that people will make, if you guys want to know, in my opinion, is not holding long enough. Impatience versus patience. Another thing that people make a lot of mistakes with is they want to chase price. They think that price will continue higher. So what I heard from a lot of people as I invest here and as I do YouTube, a lot of people will say platinum hasn't gone anywhere for 14 years plus, 14 plus years. Silver hasn't done anything, and it's a bad investment because it hasn't gone anywhere. It's 50% below its peak. That was back when it was in its 20 something, $25 or whatever. That's what they would say. And I just looked at them. I said, you don't chase returns, you buy patterns. And I don't know if people understand that. You don't chase returns, you chase patterns and valuation. That's what you chase. Then you got to make sure that you know how to set up the charts correctly. That's a skill. That's what you want to improve upon. The skill of charting, the skill of identifying potential patterns. Now, is that everything? No, it's not. You're looking for alignment. You want something cheap that has a good pattern, that has good fundamentals in the sector. Maybe these big cycles are turning. Maybe it's interest rates. You got to start looking at everything. Then you create this total picture and you start to create ideas of how to invest around it. It's an approach, it's a strategy. Kevin says, I'm going to finish a silver article shortly, but part of me thinks this picture is worth 1,000 words. The power of these sorts of once in a century moves can't be understated. We are at the crossroads of major change in how the world views stores of value. Precious metals versus bonds and cash. He's 100% right. Let me tell you a secret. It's interest rates. And interest rates going up forces money out of the bond market into other investments. If bonds is not a viable investment because interest rates are going up and bond prices are going down, well, where do you put your money? What does that look like? What has history shown us? And if we can combine history, chart patterns, and valuation together to create a picture, what does it say? How do you take advantage of it? Do we go buy equities? Do we buy the physical metals? What sectors go up the most during these conditions? Yeah, that's what I looked at. That's what I studied to see what the best investments are. And then I sat down and thought about it for years. For years, I thought about this, not days. How much risk should I take? Should I be out of the system or in the system? What are the advantages of both? What about some of the accounts to invest in, like a 401k or an IRA? What about tax shielded accounts? How much money should I put into them? Should I max them out? Of course, most of it makes sense. Yeah, max it out. And it's the entire approach. How do I fit it all together? It's a strategy that deals with taxes, that deals with asymmetry and valuation. Egon says every currency in history has gone to zero. Every single one. Why would this time be different? It's not. And that was a big cornerstone of how to set up a portfolio. Bonds, well, that's basically set up in a currency. So are stocks. Stocks are set up, valued in currency. And how do you unwind your stock? You have to unwind it going through a currency. And then as you go through the currency, selling your stocks for some sort of currency, dollars, Canadian dollars, Australian dollars, whatever it is, they're going to tax you. And they can change those taxes. So you have to figure that out. It's an easy game if you can control your emotions. That's a big one for new investors, guys. New investors are highly emotional. You got to get that in check, period. And then you have to figure out, you have to rewire your brain which is the most difficult thing for most people. This is why everything in your life is to fit within the herd, to fit in society, to be accepted by your family and society. And now all of a sudden you have to rewire it to be an investor, which means you have to wire your brain the exact opposite of everyone else to take advantage of their emotions. That's it. That's what you need to do. You know the game. You need to figure this stuff out if you want to be good. If all you're going to do is run around chasing price performance um, without knowing anything, well, you're never going to get the big returns. You can't size up the big move. You don't even know where you're at in the move at that point. So here's another one from Grady talking about platinum. He says, been posting that platinum will break out hugely soon, and it is now happening. Already have big breakouts on weekly and monthly. Quarterly below has huge breakouts in the making. Also yearly breakout in the making. So platinum is broken out on weekly plus monthly time frame. And it's now making of doing it on the longer time frames, quarterly and yearly. Means the secular bull market for platinum is now resuming. As expected, you would see. Been saying since 2020 that platinum will outperform both gold and silver in this bull market. Do not miss this historical platinum palladium bull market. Many have started to wake up to platinum and palladium and say they saw it coming, which they did not. But go with us. I've played these sectors for decades. And again, I've been playing this since 2020, this bottom. The cost curve in platinum's a little over $1,000. It's like $1,100 for the higher cost producers. You're underneath $1,000. This is like a gimme. It's like passing go and collecting $200, but you don't even go around the board. You just go back to go and you just collect $200 and you do it in a loop. When you can buy something underneath the cost curve in commodities and you're buying the physical metal, it's called cheating. Now, you know what's really cheating? Cheating is when you know a lot about the sector, the fundamentals. You know that platinum is substituting palladium and that now it's running a big deficit. Well, now it's just a matter of time. It's cheating when you look at these patterns and you have a three hump consolidation and then you're right underneath a breakout and you're running a fundamental deficit and you're underneath the cost curve. Well, that's starting to be confluence. Confluence is the merging of information that tells you a story. And platinum's cheap against all the other metals. You know, in other times in history that's occurred in other metals and the returns that they have gotten, every time in history that's occurred, the returns have been ridiculous. Ridiculous. What's ridiculous mean? Well, all of them have basically been over a 10x, almost. Gold, a little bit under when it was cheap in 2000. That was about a 10x. And everything else, some of them went up. One went from $600 to $29,000. The palladium back in the day, that was in the $100-ish range when it was bottoming. That went all the way to a little over, I think it was a little over $3,000 was his peak. Think about that for a second. How much risk did you take on to get a 20-something bagger? If you could have held through it. Maybe you didn't buy at the bottom, maybe you didn't sell exactly at the top. Okay, we'll call it a 15 bagger. Perfect. How many 15 baggers do you have? Probably not many. This is gonna yield a big move. I think $4,000, $5,000 is in the bag. Above that, we'll see. We'll see if we can get above that. I love gold, I love silver, but I think the real dark horse is copper. We need to mine as much copper in the next 20 to 25 years as we've mined in the last 10,000 years. That's going to be true for everything, though. That's going to be true for oil. It's going to be true for platinum. It's going to be true for silver. It's true for a lot of materials. That's called exponential growth. And you know what I'm going to tell you? We don't have it. We don't have that much copper on planet Earth to grow that fast, in my opinion. I think we will peak and start to go lower with time, unless we see a technological advancement. That's possible. I don't think we can go to 200 million barrels in oil. I don't think we can. I don't think we can double the production of silver. I think it's already peaked, potentially. I think gold's already peaked. I don't think we're going to increase the overall production of gold on a flow basis per year. So, I mean, there's a lot of stuff that we want to do, and I think artificial intelligence will make things more efficient. But I also think it's going to drain our commodities and resources even faster if it can. If it can. And if we can even bring it out faster. So, yeah, I think that's the last one there. Yeah, that's the last one I'll end on. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel if you'd like. Special with the coupon code. And that's all I've got for today. So we'll catch you next time. This is Finding Value.